Joining us now is Crisafulli of Vital Knowledge and Lori Calvasina of RBC Capital Markets. Great to have you both on. And it does look like S&P, NASDAQ, and Dow all finished fractionally higher here, and the Russell 2000 fractionally lower. So Adam, I'll start with you because it really does seem like we have some serious cross currents in this market. What matters the most right now?
I think what's occurring on the stimulus front is the biggest positive that is placing upward pressure on markets right now. So obviously the actions in China over the last week and a half on the fiscal and monetary and housing fronts, where they've really kind of fired a powerful bazooka that will have lasting effects. And you've seen the reaction of markets. China-linked equities, materials, capital goods, et cetera, have all reacted positively. And then you have central banks pretty much everywhere in the world, other than Japan, that are in the process of cutting rates. So most of the major central banks will all be cutting at their upcoming meetings throughout October and November. You had WSH Marks have an ECB official today, one of the bigger hawks there, kind of throwing in the towel and suggesting that inflation will return to target. You had an important comment out of the new Japanese prime minister today. That's a big reason why the yen was hit so hard versus the dollar, where he clamped down or pushed back on the need for additional BOJ rate hikes. So you have this really powerful tailwind of stimulus, and that's allowing the market to absorb relatively well. Some of the more negative developments, including in the Middle East, with the port strike, recent developments in Ukraine, where Russia has captured some territory in the last several days. All of those forces, stimulus is acting as a powerful counterforce.
Okay. Lori, I want to get your thoughts on this market, especially given the fact that it was a mixed day for mega cap tech. Tesla took it on the chin on disappointing deliveries, but you did have names like NVIDIA, which we're going to be talking about much more this hour, having a strong performance here. Given the research you've done recently, I mean, you've talked about this problematic positioning and valuation of the mega cap growth trade. Do you go anywhere near this? And if you don't, where do you put your money to work, given the fact that there are so many uncertainties?
Look, I think uncertainty, you hit the nail on the head, Morgan. I mean, what I'm seeing on my screen today, right, is energy moving up, consumer stocks moving down, and it just feels like everyone's holding their breath a little bit in terms of what's going on geopolitically. And I think that's happening at a time where we're trying to dig ourselves out of this economic pothole. Some of the economic data is getting a little bit better. But I think you're right in terms of the positioning trade. Some of these big mega cap names are just still unbelievably overvalued. We've got decelerating earnings growth. And I think it's very, very difficult for markets to know exactly where to turn at this point in time. I think if you look at certain defensive areas of the market, right, utilities, for example, has been on quite a tear. I've been answering questions for the past couple of days about whether or not it's time to get out of that sector because maybe valuations have gotten a bit too extended there. I think you can still look at areas like financials, which have very reasonable valuations. I wouldn't say they're cheap in the large cap space anymore. They're definitely cheaper down in small caps. So I think that's one place you can look. Energy moving, that is a sector that has had deep, attractive valuations for quite some time. So I think that's an interesting place to catch a bit as well. I do think, though, the problem with, what we're seeing with oil spiking today and some of these consumer areas selling off a bit, that's an area that should do well when interest rates are falling and we're coming out of this economic pothole. So I think, there's a fair amount of head scratching today because some of those opportunities that people were wanting to rotate into, have kind of gotten taken off the table, at least for the moment.
Adam, I'm looking at Nike, was down more than 6.5% today, and I think we kind of warned on overtime when a new CEO is coming in. Sometimes they don't want to set the guidance expectations too high. They pulled guidance entirely there, which certainly seems to have accelerated that. But to what degree do you think investors can focus in more on the micro, the company stories now, versus paying so much attention to that question of what the Fed's going to do? Is there more certainty there?
I think obviously earnings are going to be very important. We're right on the cusp of the calendar Q3 season. That really kind of starts in earnest next Friday. So we're going to get a deluge of updates on how companies performed over the last 3 months. And I think in general, corporate America is performing well. You certainly have some areas that are lagging behind others. Consumer discretionary is one. We know the consumer is under stress. The consumer is resilient overall, but in certain discretionary categories, like apparel and footwear, as Nike showed, there certainly are areas that spending has been softening. I think Nike is facing some company-specific problems as well. Like you said, with the new management team coming in, I don't think the CFO really wanted to set a very high bar, and that was one of the reasons why the guidance was withdrawn and the outlook was a little more gloomy. So there's a little bit of company-specific headwinds on Nike, but in general, the consumer, especially for the most discretionary part of spending, is under a little bit of stress. But earlier in the week we heard from Carnival Cruise, and they sounded relatively upbeat. So travel demand still looks like it's holding in relatively well. So the consumer spending in certain pockets are holding up better than others.